Good evening, everyone. If you can let me know that you can hear me, that would be fantastic. Great, thank you very much. So welcome everyone to tonight's webinar. Before we start, I'd like to draw your attention to the disclaimer on screen that I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorized to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current, or complete. Product or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So thank you, and thanks for joining us on the webinar this evening. I'll pull up the structure for you. It seems that markets are reflecting indecision and uncertainty on the next potentially 3 to 6 months as investors and traders look forward and try to work out if the central banks really will continue with this unprecedented stimulus as economic conditions for the world improve coming out of the pandemic of the last year. Last week was volatile. This week has seen further risk being taken off the tables as stocks dribble lower, and crypto profit taking has seen the markets sharply lower and then bounce again. So there's some serious volatility out there. With that in mind, Maurice tonight will discuss the question, is this inflation related risk aversion a short-term problem, or is it here for a sustained period? Roger will discuss stop loss protection and staggering order entry in more uncertain markets to achieve a more efficient way of getting into trades. And then Richard is going to discuss how to use moving averages when trading intraday and walk you through a case study example. As always, please put your questions on the chat the minute that you have them so we know what's coming up and we can answer as many as we can before we get to the end of the presentation. Okay, with that, I'll pass over to Maurice. Maurice, over to you.
Thanks very much, Chris. Welcome back, everybody. As we go on through these interesting markets, a busy day today again, and I think we need to sort of be prepared for what's driving some of this volatility. And for me, I think there's a certain amount of question and concern over inflation. Are the central bankers right and that inflation is going to pass, or are the markets beginning to sort of test them? So inflation concerns are certainly putting investors on edge. I mean, look at the S&P last week. We saw that nervousness into the US inflation data that came out much higher than expected, even though a big one was expected. We saw the move take stocks down as bond yields went higher. But then really post CPI data, we saw the bids come back into the market, and it looked like stocks were going to roll over. And again, we've seen this today. Stocks looked extraordinarily weak at one point today, but again, we find these bids down there. And this is probably to do with the fact that the Fed is still suggesting that not going to do anything with rates or policies or tapering. So they're still adding liquidity into the market. And so these dips continue to get bought. So here we are, we're back up and then back down, then back up. So why the inflation worries? Well, what is inflation? It's a general increase in prices and a fall in the purchasing value of the currency involved. We have a situation where we've seen a surge in inflation, which was expected as the world recovered. This due to the economy is being put into basically a forced coma, and the unlocking from that actually presents quite an awful lot of pent-up demand, where you see a massive release as businesses reopen. You get this surge into the economy again, and I think realistically you can see this from oil. We saw that push down in oil that happened, and then look at us back. We're looking at demand coming screaming back as we start seeing the economies reopen. Interestingly, the rest of the commodities got a boost as well from not only historically low borrowing costs, but talk of the government starting to spend money on fiscal spending, on infrastructure spending, climate control, and things like that. So all-time highs in copper, palladium, iron ore, all sorts of things flying up. Now these prices start moving into the broader consumer products, because obviously these prices have a knock-on effect. So it's interesting to know, what is driving this, and I think it's monetary policy, but I think it's fiscal policy as well. So central banks have told us they're anticipating this inflation. They're saying to us that it could be transitory, prices will settle down. This is what you expect in a recovery. The point is that have we ever seen so much government spending collectively from governments around the world in peacetime? I'm not sure we have, and I'm not sure that the Fed models can actually sort of model this, in fact. So we are looking like CPI is moving back closer to its 2%, but the Fed wants to see an average 2% now, which means a longer term period where it can rise above that 2%. And let's face it, the CPI data that the Fed uses, or the core PCE that they prefer, is a very poor indicator of inflation at grassroots on Main Street, and it doesn't pick it up for particularly well. So why the market volatility all of a sudden? Some investors clearly believe inflationary forces may not be transitory, and that could see a threatening the V-shaped recovery. This means that the consumer could actually see higher inflation taking prices to levels that they're not prepared to put up with. So there's a couple of areas of concern here. If we look at the Bank of Canada, they were the first bank to signal an exit from some of the stimulus, or let's say a reduction in bond purchasing, and you can see what that did to the Canada. So dollar Canada went down. That means the Canada is rising quite strongly after they did that. Who is going to be the next one? So inflation matters, and the reaction to it matters as well. So inflation is forcing central banks to possibly act earlier than they may have thought they needed to. Bank of Canada the first, who's going to be the second? The other problem out there is that we get what's called stagflation. Now, stagflation is a nightmare for central banks. So what it is where prices continue to rise because of, let's say, governments trying to stockpile raw materials for renewable energy projects and climate control, or greener credentials, if you like. But unfortunately, to cap those prices, if the interest rates start moving higher, then the central bank will actually kill the very growth it needs to bring us out of further into the recovery. So stagflation is about as bad as it gets for a central bank. So we have a problem here looking forward. So for me, I think we've got to ask ourselves if the major economies like the US and China are actually beginning to move towards peak growth. Maybe even Europe, I don't know. But I do think it's worth keeping an eye now very closely on the forward-looking data. And that we have some PMI data, as you can see on the left here, on Friday. I will be looking at this really closely for any signs of weakness starting to move in. This is forward-looking data. And we have ISM at the beginning of the month, next month as well. So I think the data is going to matter a lot more now as we go forward. So, you know, I'm very keen to see how this pans out. One of the worries I have is that, you know, stocks may be telling us that maybe it's time to sort of take a bit of a breather. Inflation, you know, one of the dangers that come from inflation is volatility. Now, if volatility is going to hang around, then we've got some problems with markets that seem priced for perfection, if you like. So on the long term, unprecedented time of collective fiscal spending, boosting commodity prices. This collective spending on infrastructure is going to make a difference, but it's going to last for a long time. This is a macro strategy from governments to spend a lot of money over a long period of time. So the strong push to grab basic resources while stocks last could actually see commodities continue to rise and inflation possibly hold on. In the short term, you know, we've got to look at this as well. We've got pent-up spending risk as household savings rose strongly, as consumers were unable to spend during COVID. But that will probably pass, and it often does, particularly if prices do start to sort of go up exponentially. Then, you know, consumers are going to have to suggest that essential costs are stopping them spending on discretionary products as well. So these commodity prices moving higher into consumer products is an issue that could hit the consumer. So I'm keeping a very close eye on things like retail sales, consumer sentiment. You know, we've had some pretty poor data from those just recently, particularly in the US, and I'm going to be keeping a very, very close eye on those going forwards. So monthly inflation data obviously is massively important. Unemployment as well, because the Fed has told us that they really don't want to move until they see significant improvements in unemployment. Now, the problem I have with that is that unemployment data is a lag to the economy. The economy moves faster than unemployment moves, and so therefore they could be looking backwards when they should be looking forwards to deal with inflation. And I find that rather surprising, which makes me think that maybe this is all about something else. So if we look at the commodity index, you can see the steep rise that we've had in the commodity index. To me, I think we could be in the middle of this move rather than the end of it. And I think we really have to sort of keep an eye on commodities going forwards. They are going to make a difference. We are beginning to see a slight nudge up in US Treasury yields as well. This is the 10-year yield you can see on your screen now. And I think, you know, we're stuck in a bit of a range with 10-year yields at the moment, but I think the danger here is that they nudge back up above 1.7% and start pricing in some of these hikes for the Fed. And I think that's going to have an impact on things like commodities and the dollar as well. So I think we've got a period of some risk coming up here, and I think we need to be very wary of volatility. I think we need to sort of consider what sort of leverage we have in the markets, and I think we need to sort of ask ourselves how we adjust our portfolio for risk management sort of structure, if you like. So if your confidence isn't really high, you know, here's a table that Roger's used before. I like to use again. If you're in medium, if you're not 100% sure of how long you're trading for or what may be impacting, reduce some of the risk, put your stop in the right place. Don't have entry orders and stop losses really close, because in a volatile market, you will inevitably be hit. So reduce. What I would suggest here is you decide where your stop should be. Work out how much you want to spend on this trade, and then put the amount in and do your trade, not the other way. Work from the back where your stop should be forwards not from where I want to buy here, then I'm going to put a stop in because I want to lose 100 quid or $1,000 or $2,000, whatever. It's the wrong way round. In markets that are more volatile, you need to do it the other way around. Find out where your stop should be, see where the market is now. That tells you how much you've got to risk, and then you can put that amount on. So I think you've really got to keep to small, medium positions at the moment, because I think unless you're day trading and you're on a smash and grab sort of structure, then I think your risks are pretty high. I do think there's going to be quite an interesting few days, particularly after the moves we've seen today. I mean, the S&P is 40 points off its lows already today, but it's still looking like it's a high risk trade still, and the market has got a lot of margin debt in it. So taking profits, keep your powder dry, be smart now. This is the time to be smart, and I think everything you've learned from us over the last few months hopefully will have you prepared for these kind of markets now. So be prepared for more uncertainty is the key message here going forward. And on that note, I'm going to pass you over to Roger, who's going to talk to you about sizing your positions, stagger your entries, and deal with stop losses professionally. And I think this is going to be a really good section for you. Roger?
Thanks, Mo. And yeah, nice intro. We are going to continue talking about, you know, position size, the amount of risk we put into the market. And, you know, I don't want us to always come across as defensive and a bit negative and trying to get people to be, you know, uber cautious. You know, what I think we're asking people to do is to respect the market, respect the size of the market, and certainly, as Mo quite rightly put there, respect the volatility that's in the market, particularly at this current period in time. So, you know, sizing your position is important. But, you know, from this piece I'm going to do tonight as well, hopefully, you know, you see if you actually have some good strategy and you know, a couple of little tips from us, you know, on how to put risk on, you know, but still stay within some of those strict disciplines that we like around protection and stop losses, then, you know, your trading can certainly be profitable, and you can feel like you're actually, you know, owning risk and not frightened of it. So, you know, we have been on the, you know, a few sessions around stop losses and protection. And tonight we're going to look at the whole concept of making sure you don't put things too far away, that you really are wasting your trading capital. So, you know, all stop losses should be at, you know, a level that's key in the market, but also actually poignant to what you're trying to achieve in a trade. And the other thing around risk reward, you know, making sure your profit areas, excuse me, are relative to your protection areas, your stop loss, on a consistent basis over a series of trades. So here we are in the scenario that we've put up, and we're actually just going to give you a quick idea around risk reward, and hopefully this resonates and help you to improve that part of your trading. So we're in this situation, you know, that is that Chris on the left? I'm not sure. Anyway, he wants to buy, she wants to buy 115.50, just any old rate. We're not relating this to any particular product. And actually then go through the process of doing a little bit of analysis. You know, we look at those charts and we've found that if we want to buy, one of the things we look at, you know, in early doors is where do we want our protection? And we've actually done our homework. We've looked at some support levels down there, 114.80, 114.25, 113.65. So all good to start with. You know, we're actually doing, you know, the right things here. But then we actually start to structure our trade. And all of a sudden, you know, if we're to look at our first support line there at 114.80, and we put our protection at 114.75, far too many occasions traders will look to take profit at 115.75. And clearly, if you look at that, you're looking to take 25 pips profit, but you're willing to lose 75 pips. Now, you may get away with that on a few occasions, but the pure logic suggests that for every 3 that you get right, the minute you get 1 wrong, everything's back to square, everything's back to flat. If you go on a bad run, which we all do at times, and we get 2, 3 wrong to start with, if you continue like this, your risk reward and the ratio of successful trades versus bad trades is never going to make you money. So this is something that's very, very key. So we need to make sure our take profit area is relevant to the level of stop loss protection that we want. And so here, even if we look at that situation, we've pretty much got a 1-to-1 situation if we're targeting that 116.20. If you don't think the market's going to reach there, then you've actually got to start thinking a little bit differently about your trading. Your stop loss in this instance would need to be a little bit closer. You certainly would need to be wary as it moved against you, because you just don't want to fall into this trap that we're showing you here. So, you do need to think about this before you actually put the trade on. And the other key thing here as well is if you put your stop loss way too far away because you're frightened of taking a stop, this thing may go sideways for ages. You'll never be stopped out, even though it may be in the red as such for a long period of time. And you're actually, the one great thing Mo said there was keeping your powder dry. Your powder's not dry here. Your capital's being used up in the market. It's going nowhere. And partly this is because you were maybe frightened of taking a stop loss, so you moved your protection way too far away, and you end up just getting frustrated on a trade that's tying up your capital. So one of the other things that we need to do is think about duration. And I think it's true to say, if you feel you're looking for a bigger return, and as we see there, we've got some take profit levels. Clearly it's going to take a while for the market to move to those levels, and therefore your duration of trade is potentially going to be longer. What that does is bring in the risk of it moving against you. The longer you're in the market, there's more probability of the market moving against you off the back of either some information or a headline or whatever that could take the market by surprise, or simply you're wrong. So you've got to make sure again that your protection is relative to keeping you in that trade as long as you feel it needs to get to those profit levels. So that's where we can start using the protection levels that are a bit further away, and they're perfectly valid. When on the previous situation, I was actually suggesting that 114.20, maybe that was too far away and you get stuck in a sideways move. But if you're actually looking for a slightly longer term move, then you probably would be valid in putting the stop loss even lower than that. So it's not always the case that because it's a long way away, it's wrong. It needs to be relative to the duration of trade. So we're going to talk about staggering our entry orders, and again, a bit of a technique that can help us if we, if we feel the market's got the possibility of going against us, to a reasonable magnitude that we want decent stop loss protection, but we actually do still want some risk in the marketplace. So, how can we gain, this risk reward that we've been looking at and asking you to look at? So, we all know it's very, very hard to predict the top or bottom, to sell or to buy and gain the benefits of the retracement. Because the market's moving all the time, and despite using charts, etc., there's generally an overplay in up and down moves. So trying to pick the top and bottom is very, very difficult, and we have to be cognizant of that. So what do we get out of staggering our entry orders? You get the fact that you don't have to be perfect in your entry level, because it's not just a single trade. It's going to be a group of trades that's going to help you achieve your goals in this instance. So the other thing as well is that because of the structure of this trade, you can end up allocating a higher level of capital to this trade, and that's a positive. It's something that can help us. We're using the market. To a degree, we're going to allow the market to come to us to achieve a better average of trades, and hopefully get the benefits when it moves in our favor. And we can clearly have protection at slightly further away as well to achieve this, and that's because it's still going to be in the right place according to this structure. What's the downsides of it? Well, although you don't need to be perfect, you do need to be patient, and you have to plan this to start with. What I'm going to show you in the next few slides is a structure. It's a plan. There are some people that may look at this and think, oh, I do this all the time. And I'll show you potentially why you're not doing what we're asking you to do as we walk through those slides. And that's something that you definitely want to avoid. And the other thing as well is you have to accept that you may not get every tranche of this this strategy, this staggered strategy. So you have to be aware of that. But the benefits of that is if you don't achieve and get all tranches of it, that means the market's moving in your favor. So that in itself is a positive. So what have we done? We've identified the relevant levels. All these things are on the the process wheel. We're looking to allocate capital to that trade idea, and we actually have chosen what we think is the right level of protection, relative to our confidence and relative to the volatility into the market. So now what we've got to do is plan these entry orders. How do we do that? Quite simply, we look at the place where all the information is there in front of us, and that's a chart. We've chosen our product. In this instance, we're looking at S&Ps. We want to buy, if we look on the top left-hand side there, at 38.90 is our buy area. We're doing that because the market's dipped. It's still, I'm sure Richard would say, in a positive constructive trend here, and we've just taken a little dip, and maybe we're doing this off the back of that, maybe the mid of a Bollinger, etc., things like that, and so that level is important to us. But actually, we're looking on the right-hand side when we allocate capital, and we're in at a 5 here. I've got us in at a 5, and that's because the simple logic that the other side is we're going to look to put our stop loss, where we want our protection, a bit further down. And so by definition for me, if you're looking for more protection, that means you're not quite so confident of this trade. There may be some volatility in the market, obviously, but that's, one of the reasons why, a 5 could be, the right level of capital we're going to put into this trade. And so if we're in a situation here where we bought at 38.90, it's just above that support level at 38.86. We don't want to put it right on that level. And we actually think the protection level is 37.90. So we're down there, and if we put our, let's say it's £5 per point on, that's a confidence level of 5 out of 10. 5% of our capital, if we had £10,000 sitting in our bank account, that'd be nice. We're looking to say to ourselves, I don't want to lose any more than £500 on this trade. So my level of confidence is appropriate to how much I'm going to lose on this trade if it goes wrong for me. And clearly I've got, a previous low. I've got 1, 2, 3 levels of support. It needs to go there. So, I hopefully am quite confident it won't get down there. And then from a risk reward perspective, I look at my take profits, and actually where I think I should be taking profit up there, I'm only going to achieve a profit of £400. What's wrong there? Well, clearly my risk reward isn't, it's not even 1-to-1, you know, and we want it to be positive, you know, 2-to-1, 2.5-to-1. There's no formula, but we need it to be positive over a series of trades. So I've got to think, how can I do this and achieve a positive risk reward and not fall into that trap we spoke about? Well, let's start looking at staggering some of these orders. So if I get myself into a situation where £500 is still my loss level, I don't want to go beyond that, I'm now actually going to look to buy some tranches of this product just above some of those other support levels, and I'm going to put those orders in the system. And so I'm going to take the benefit of the market. Although the market's moving against me, I'm going to take the benefit of that, and effectively I'm going to buy into the dips, because I believe that in the end it will start moving back up to those take profit levels. So I need to structure those in a way that you know, I'm still actually keeping myself to the £500 potential loss. And so what I'm doing is actually putting some bids in just above those support levels. I clearly reduce the amount of each tranche. So just by an example here, I might buy £2 worth at 38.90, my original entry level. I then wait for the dip. I want to buy another £3 worth at 38.70, just above that other level. So it's 12 points above that 38.58. You know, that's not a given formula again. It could be at 38.65 your bid, but we put that in here just for the example. And then I'm going to put another bid in for £2 worth at 38.20. My average for all three of those trades is now at 38.61. If I got stopped out at 37.90, I would still only lose £500. That's important to me. I don't want to lose any more than that. But what have I done here? I've actually achieved a bit more capital allocation into the trade, because now I've actually got 7 units in it if I were to get all of these tranches. And obviously, if I've got more in it, I've got more leverage when the market starts moving in my favor. So I'm actually building leverage into this trade whilst continuing to keep my protection level, my maximum loss at the same level. So there's some nice positivity in this trade. The key thing here, and what I mentioned before, is if I was to get all of those tranches, I would now be £7 long at 38.61, and if I were to take profit up there at 39.70, my profit will be 763. So by changing the structure of this, my risk reward has now moved to 1 to 1.5. I like that. That's good. Over a series of trades, that's good, and that's what we want to be achieving. So that all looks nice, doesn't it? The problem is, as we said before, one of the downsides of this is that you may not get all of those tranches. And as we play this through, we've just given the example where on a further dip, and this is it's a proper chart, so this happened, we managed to get 2 of those tranches. We didn't get the final one. So we've ended up buying 2 at 38.90, 3 at 38.70. My combined entry level is at 38.78. As I said, it's a shame we didn't get that final one, but that means the market's moved back in our favor. We've got a slightly better average from our original entry of 5, so we're now 5 units long at an average of 30. Where are we going? Yeah, an average just below where we would have been long if we'd have just gone and bought the straight 5. We still got our protection down there at 500 points, and the market's rallied to 39.28. If I were to take profit here, because the market felt different to me, I could actually sell it to £250 profit, or clearly I wait for it to rally up to our original profit level. I've got those options, and that profit level would be there at £460. Now, okay, someone could say to me, but that's less than 1 to 1 because you would have lost £500 and now you're only taking a profit of 460. I would agree the strategy hasn't quite gone to plan because we didn't get that final tranche. But what I've done is actually moved it up to a lot closer to 1-on-1. I've got more structure. I've not risked more money. And I have to think on the positive side that if I had have got the final one and it bounced in my favor, I would have had more leverage going into the take profit level. So, you know, this is a structure that doesn't always come off. The key thing about there is if it completely goes wrong and it goes through your stop loss level, you still only lose the same amount of money. But if and hopefully it bounces back in your favor, you're going to make more and your risk reward is going to be more in your favor. The one thing I do want to mention here, where lots of people say, I do this all the time. I guarantee you don't do it in a planned and structured way. I guarantee you buy, and then when it goes down against you, you'd buy again because you just want to average because you always think it's going to bounce. You're not buying it in a structured way. If you're buying it then, I guarantee you would have bought 5 to start with, and if it moves down again, you know, just for a number, then you would buy the same amount again. The problem with that is when it all goes pear-shaped and you start taking your loss at 37.90, your loss won't be £500. By then, it's going to be £750, £800, things like that. And what you're actually doing is doubling up with the hope that it bounces in your favor. You're not doing it in a structured way like I've just showed you. And that's actually very, very dangerous because sometimes you might be doing that in a market where it's just you're trying to catch a falling sword. And those are the days that we want to avoid. Those are the days that can really take you out. The art of a good trader is to make sure you keep your losses down to a minimum and you leverage it when it moves in your favor. When you double up in hope, those are the days, the big days where you take a big hit. You take a big hit to your emotions and unfortunately a big hit to your bank account. So please don't confuse that as the same strategy as I've just been walking through. So I think that's me done for the evening. Well, I'll stay around for your questions, but now I'm going to hand over to Richard, who's going to talk about using moving averages on intraday trading, which I'm sure you'll all be very interested in. Over to you, Richard.
Great, thanks very much, Rog. Good evening, everybody. Hope you've had a good week so far. Tonight, what I thought I'd look at is a trading strategy based around moving averages and designed to offer an intraday perspective. So it basically gives you much shorter term time horizon. We'll be looking at 1 hour charts, and that tends to be the basis that we look at this strategy developing. And it's just designed to flag up opportunities within a trending market and hopefully taking full advantage of that trend as and when it starts to develop during the day. So just a quick recap on moving averages, which we've spoken about in the past. Now, there's obviously a number of moving average techniques, and you can see quite a few of these on the internet and just search trading techniques for moving averages, so on and so forth. But this is just one that I find useful. I've used it sort of on an intraday perspective, and it does throw up some quite interesting trading opportunities and signals. Now, there are a number of indicators that are based around moving averages, such as the MACD, Bollinger Band, so on and so forth. So, even when we're using these indicators, it does allow us to trade by using moving averages. But this type of approach is much more geared towards a shorter term aspect and to highlighting the trending conditions of the market. And basically, if I use outright moving averages, I prefer to use the exponential calculation. Now, the reason for this is that it puts greater emphasis on the latest data points within the calculation. So in other words, it moves more quickly and reflects price movement much more quickly than a simple moving average calculation. So in theory, it gives earlier signals and we get earlier opportunities to take positions and look for new trends to materialize. Now it's based around two moving averages, two exponential moving averages, a 5-period and a 10-period. And basically the first signal is very, very simple to use in that it highlights a positive trending condition from a short-term perspective when the 5-period crosses above the 10-period. So the short-term average, which is much more quicker to react to price movement than the shorter term, crosses above the 10-period, and that suggests that we're now trading within a positive trend. And if we're short at the market, we need to close that, reverse, and actually go long. When the 5-period crosses below the 10-period, then it suggests that a downtrend is developing, and we need to close longs and go short to reflect the new signal and the potential of a new bearish trend beginning to materialize. Now, moving averages don't work that well when prices are trading within ranges. Markets will move in a very choppy sideways pattern, and this will basically move either side of a moving average, and the signals will, you will get whipped a little bit in terms of those signals. So you'll see buy and sell signals developing fairly quickly. So I try and filter out this noise by using the MACD histogram. Now this is a variation of the MACD that's available on what should be all trading platforms and charting systems. And basically this takes slightly longer term moving averages and measures the gap between them. So if the slightly longer term moving averages are above each other, again, the shorter term above the longer term, then the histogram will be colored green, and that will be reflecting a more positive trending condition. So it will basically dictate what type of risk we take within the market. So basically, if we see the moving averages, the 5 and 10-day period moving averages crossing higher, but we're not seeing an aggressive trending signal from the histogram, then we'll take half the original position. So we'll take half the risk. But if we're seeing the signal developing with an aggressive trending signal from the histogram, then we'll take a full position. So we'll take outright risk and then look for that develop. But hopefully that'll become clearer as we run through the example that I've got for you. Now, this approach is a stop reverse strategy. So in other words, it means that whenever you're actively trading within the market, you will have a position, be it long or short. You're taking the position based on the moving average structure, and if that changes, you will still have a position, but you'll reverse it and go long or short, depending on your original trending signal. So whenever you're active in the market, you will have a position based on the moving averages. So this means that you need to be much more aware of what's going on in the market, the signals that are being generated, and basically being able to sit in front of your trading screen to actually see these trends beginning to develop. Now, the good thing about moving averages is that they're great in trending markets. It keeps you within a prolonged move. So in other words, when the market continues to move higher or lower for a prolonged period, then moving averages will keep you within that ongoing trend. The bad thing about them is that they are slow, even with an exponential calculation. So in other words, price has to move a moving average. So we have to see price reflecting a change in direction to see a reversal developing within moving averages. We overcome that slightly by using exponential, but it can be an issue still. And the ugly is that a period of sideways activity is not good for moving average strategies. No matter how you try and filter out some of the noise, if you are in a prolonged sideways trading range, then the actual structure of the signals will not be that reliable. So we need to be aware of the trending condition as well. So let's take a look at the an hourly chart of the S&P index, and you'll see that we have the blue line, which is the 5-period, the 5-hour exponential moving average. The red line is the 10-hour exponential moving average, and below we have the MACD, which is exactly the same parameters that I've looked at before. So we're using 10, 20 exponential moving averages to measure that gap. So if the 10 is above the 20, then we're seeing the histogram colored green and rising as those averages rise. And we're using a 9-period setting to give us the smoothed version of the MACD. So effectively, we're looking at the S&P index, looking at the trending condition, and using to filter the histogram signals with some of the to get rid of some of the noise, if you like. Now, this is a system that keeps you in the market. It's a stop reverse system. And don't forget, you do need to sleep. So there will be times when you're out of the market. Now, when you look at a manual trading system such as this, then you need to take that into account in terms of your trading hours. Now, I'm using London times because obviously that's the time period that I'm active within the market. So you can see, I mean, I am being slightly generous in terms of time, but so I'm using 7 a.m. London time through to 9 p.m. London time, which is when the S&P closes within the US market. So effectively, the sleep periods are these blue blacked out areas. So effectively, we will close the position at 9 p.m. no matter what, because we don't want a position overnight to run that risk. So effectively, what we're looking for, if we look at the first period, which was April the 12th, we're looking at, from the open, the 5-period moving average is above the 10-period. Now this suggests upside. So we're in a positive trend from the moving averages. The risk is for that trend to continue. However, if you look at the MACD histogram, it's not confirming an aggressive upside move. So in other words, because the histogram is red, the slightly longer term moving averages are not confirming an outright positive position, but this means that we want to take advantage or try and take advantage of the shorter term hourly signals that are being generated. So we take half a position. We're less committed to this signal of the positive trend. So at 7 a.m. when we come in to start trading, the 5-period exponential is above the 10-hour exponential. So we take half a position because the histogram's not confirming at 7 a.m. and that level was 4115.58. So we're long of the market half a position at that level. Now, only a sort of few hours later, as the market continues to move higher, you can see that the short-term average remains above the longer-term average. So we're actually holding this long position throughout the session. So we close at 9 p.m. at 4129.30. And that gave us a profit in the S&P index of 13.72 points, which we halved because we only had half the risk that we normally take. So that gives us a profit on the first day of plus 6.86 points. So we can see that we've taken advantage of this moving average structure. The fact that the 5-hour has remained above the 10-hour throughout the session means that we've maintained that long position and closed at the last opportunity to trade as the US market ends. We then move on to the April the 13th, and the day starts at 7 a.m. in London time with the moving averages at the same level. So there's effectively no trade to be taken as we start our session. The 5 exponential moving average crosses above the 10-period exponential moving average, but once again, the histogram is colored red, which means that we're not seeing the confirmation of an outright positive trending condition. So we take half a position, which is established at 4130.46 at 8 a.m. London time. The market then sells off very sharply, as you can see, and the averages cross lower. So this means our stop was activated as the cross lower occurred at 4125.55, and we lose because we had half a position in place a total of 2.45 points on the S&P within that initial trade. Now, obviously, because the moving averages have crossed lower and the histogram is negative, we've taken a fresh short, we've reversed our half long position, reversed that on this moving average cross lower and the histogram being negative, we've reversed that to a full short position at 41.25.55. So we're now short of the market at this period here, looking for a downtrend to materialize. However, the market rallies and we're stopped out as the averages cross higher at 41.30.17. So again, we've stopped out of our full position. We've lost 4.62 points on the trade. And because the averages have crossed higher, but the histogram is not confirming, we take a half a position long at this stop level of 41.30.17. And that runs through until 9 p.m. because the short-term average remains above the longer term, and we close at 9 p.m. London time at 41.41.15. And that gives us a profit on the half position of 5.49 points on that particular trade. So the session as a total, we're losing 1.58 points on the day for that particular trade signal. So we go on to the 15th, and we can see that the market opens at 7 a.m. with the short-term average rising above the 10-hour moving average. And if you look at the histogram, then we're looking at a strong trending signal coming through from the histogram as well. So that gives us confidence within the long position, and we go long a full position at 41.33.93, and we can see that throughout the session from 7 a.m. London time to 9 p.m. London time, the market rallies with the backup of this histogram, and we continue to see strength developing, and that gives us 37.26 points on the trade for that particular session. Now, I'm not going to go through all the rest, but you'll see with the next slide that we list all of the profits and losses by using this approach, be it long or short, just by using the shape of the moving averages, the 5-hour and 10-hour exponential moving averages alongside the histogram to confirm these trending conditions. And you can see that over this period of time, between April 12th to the 21st, the grand total for the 8 sessions was plus 82.62 points. Now, this type of performance obviously isn't guaranteed. Past performance doesn't guarantee future signals, but what it does is to allow you the opportunity to have a position within the market with either a confirmed trending position, so you're actually risking more within that trade, or you're reducing risk but still looking to try and take advantage of a trending signal reflected by the moving averages. But again, it's designed to give you a trading signal and a position throughout your trading day, and to try and take advantage of the trending signals developed and signaled by the moving averages as they evolve during the trading session. So it's just an approach that we can use moving averages to really sort of try and focus on trading opportunities to take advantage within that trending condition, but also stay with the trend when we're seeing more aggressive signals beginning to materialize. So that's the look at moving average trading strategies. That leads me to hand back to Chris, who's going to look at your questions. Thanks very much, Chris.
Thanks, Richard. Thanks to all the other mentors as well for some great content tonight. Richard, if we can start with you, do you find that the moving average is one of the more successful ones, or do you prefer? What's your preference? Do you prefer the Bollinger Bands, or do you prefer other indicators? What's your thoughts?
In terms of indicators, one of my favorites is the Bollinger Bands, because I go on about it every week. People may have picked up on that. But even that is a moving average based indicator. And then obviously taking into account standard deviations above and below that 20-period moving average. So, for me, from a trading approach, then using Bollinger Bands is very useful and reliable. You could use, for instance, Bollinger Bands alongside the strategy that we've highlighted, and instead of perhaps using the histogram, you could use the structure of Bollinger Bands, if we're accelerating and bands widening, seeing increasing volatility, and the moving averages are obviously, the shorter term moving averages are giving you those signals, then you have that confirmation to back up that. But using indicators outright, then I would tend to favor the Bollinger Band, if I'm honest.
And we talked a lot about volatility tonight. Do you think that the Bollinger Bands are a more useful tool for these more volatile markets that we're seeing? Or do you think the moving averages will?
Well, the moving averages will give you the trending signals. What the Bollinger Band actually does is to highlight when, in putting in a much easier to focus graphical form of when that volatility is increasing, but importantly when it's decreasing as well. So if you're holding a long or short position within an accelerating trending market, which is seeing increasing volatility, it's only when you start to see the bands contracting that you start to see a reduction in volatility and the risk of a consolidation. So basically you can step aside and look to close your position and then see what happens from there. So yeah, it can be very useful in volatile markets.
Okay, great. Thank you very much, Richard. One for you, Roger. Can you use this strategy, and have you used it to, the scaling it when you scale into positions? Can you actually use it as well to scale out positions? Is that something you've used in the past?
Yes, certainly. I think from a scaling out perspective, you may have some planned take profit areas in mind, but one of the key things when markets move in your favor and you're looking to take profit is you should be looking and feeling price action as well. So maybe when you're scaling out, you're doing it on a kind of more of a feel basis because you feel the market may be getting a bit exhausted. And that's where I'd be looking to scale out a bit. I may still like the idea, but if I feel price action's lost a bit of momentum, sometimes I'll look to sell out a bit of my position or buy it back. But yeah, it's a very, very similar style. I would say it's not quite so pre-planned. It's more as you feel the market move.
Great, thank you very much. One for you, Maurice. If the inflation is transitory and the Fed is right, do you think that's a positive again for stocks? Or, and basically, if that was to happen, when would we find out? Is it a long way down the line?
Yeah, I mean, they're telling us it's transitory, but the only job is we can only find out when it actually appears that it's transitory, which is sometime in the future. So it is a bit of a conundrum. I mean, the Fed minutes that were released just a few moments ago suggested there was some discussion coming about tapering bond purchases. So if they are right, then I think that means the Fed would stay on hold with policies longer, and that would probably suggest liquidity would continue to be put into the market, and therefore stock markets would probably start to go up again, because realistically that is what has taken them up over the last 10 years, has been this very active central bank activity in bond markets, which is pushing liquidity into markets. So I'm not sure that it's needed. Policies are set for a demand shock. We haven't got that. We've got the opposite. So realistically, they should be adjusting policies, but they are still talking that way, and they're still suggesting they're not going to move for a while. So this is why we still keep seeing the dips in stock markets. When we get a risk-off move like today, we're seeing the bids attract again, just because there's no information from the central banks that they're going to change anytime soon.
Okay, thanks very much. Was that the Fed minutes were just out? At 7 o'clock. Was there anything in that has sent stocks lower or crypto back lower, or was that just the market?
It did, yeah, it did. There was some sort of suggestion in the minutes that the discussion on tapering was beginning to take place or would take place. And I think on that basis, we saw stocks come off quite hard again. They've since turned around and gone back up again. So it's an absolute mess. It's a volatile session. The market's trying to get to grips with what everything means. There was a reaction to that release of Fed minutes. I mean, I think the S&P dropped about 20 points and it's taken them all back again. So it's all over the place at the moment. It's a very choppy night. I think you need to be careful out there at the moment. I think we've got a few days of volatility coming.
Okay. Do you think the dollar, if this volatility continues, I mean, obviously we're seeing the dollar come off quite a bit. That feels like the trend that the market wants to try and take the dollar lower. Do you think the dollar will find buyers if stocks continue to be volatile and this uncertainty carries on?
Well, I've been extremely amazed at how weak the dollar has remained this last day or so. I mean, we've had quite a decent sell-off in stocks the last couple of days, and we've still got the euro above 122. The Aussie hardly moved, off maybe 50 pips from its highs yesterday. The dollar is snoozing through this. I'm quite surprised at that. One would have expected a sell-off in stocks to the degree we saw today at one point, that we'd have seen people buying dollars against it, because we've had this inverse correlation, if you like, between the two, but we haven't seen it, which is very interesting, which suggests to me if the dollar can't rally on a day like this, then it's probably not going to rally for a while. And I think that trend is still intact, to be honest, on the downside. I think the dollar overall still seems to be in its longer term downtrend.
Great, thank you very much. So there are no other questions, so we're bang on time, so we'll leave it there. Thank you very much for everybody for attending tonight. I just want to remind you, 7 p.m. Sunday, the invites go out every Thursday. That's the Sunday night pre-market open webinar. Thank you to all those that are attending. We'd love to have more attend, so please join us. That's this Sunday, 7 p.m. And obviously Pepperstone are able to give you a recording for those that register as well. So if you'd like that, please join us. Okay, have a great week out there. Be as Maurice, Richard and Mo said, be sensible and watch out, but all the best. Thanks very much.